Welcome back, class. This is chapter 4, merchandising activities. And this chapter highlights the differences between a service business and a merchandising business, shown by these diagrams here to indicate the differences in the calculation of net income and here in the net income statement. And you'll notice the difference between the income statement for a merchandiser, where there's a cost of goods sold line, and a service business where there is not. Basically, that's the big difference. You're going to calculate a gross profit on sales in a merchandising business. Here it will simply be a net income after expenses are deducted. We also are going to look at reporting inventory. How do we account for inventory? Merchandise inventory are the goods or items that we intend to resell in the business. And we'll talk about the operating cycle. And the operating cycle is simply the time it takes to start with the investment of cash and then turn that investment of cash into actual cash itself through the sale of our products. Inventory systems are going to track all the goods that we buy and sell. And through an inventory system, we're going to account for what we had to start with, what we purchased, and then what we have in ending inventory and the calculation of cost of goods sold. Now, if we're using a perpetual inventory system, which we will use here in this class, we're going to be on a regular basis accounting for the cost of goods sold as we make those sales, both at the retail amount, the sales amount, and the actual cost amount, which is what we've recorded in inventory. On a periodic system, we would only update the inventory at the end of the period. That's really not very realistic today. The more prevalent system is a perpetual inventory system that allows retailers to stay up to date on their inventory much more efficiently and basically be able to operate with a greater control of their inventory. Now, as we go through this, we're going to get to purchases. And how do we account for those? Well, if we're just buying something with cash, we don't have a cash discount in the purchase, we're going to record the purchase amount as an addition to merchandise inventory, which will be a debit. And then the cash that we use to purchase that with will be a credit and a reduction of cash. If we buy it on credit, we'll be using accounts payable here in the credit side of the entry instead of cash. Now, there's going to be times we'll have a cash discount, and basically many suppliers will encourage early payment of the invoice, and to do that, they'll offer some kind of a small discount if the invoice is paid within a certain number of days. So the way that you'll see this phrased is the generally whatever the percentage is, like here 2%, it'll say 210, that's 2% if paid within 10 days. And then net if it's paid within 60, and net basically is the full price. So you have a discount period from here to here during which you can actually pay the lower amount. The full price then would come into play out here if you were in the invoice period. Now, when we purchase these items on credit, we're going to show that as a credit to accounts payable rather than cash. And typically that's how we're going to do this, because we'll have an invoice, and if we have an invoice, it means that we haven't paid it yet. So we're going to record that in accounts payable, and we're going to keep track of these terms to see if we can take advantage of the discount. So here we ordered some goods with a 210 net 30 discount, and here exactly 10 days later we're paying this. Well, we are going to pay it, and what we're going to do is we're going to have a discount. So we're going to take the accounts payable, which is the amount we owe, and debit it for the full $500, which is the full amount of the invoice. We are going to calculate the 2% discount, and that's going to be a credit to merchandise inventory because that credit, that discount, is a reduction in inventory cost. And then the last credit for the difference will be the cash. That's the payment that we're actually making. The T accounts would look like this if we were using a T account analysis. And if we just paid after the discount period and during the credit period, our payment would look like this: debit to accounts payable, credit to cash. Now, there are going to be times when we purchase, we'll have returns and allowances. That's not going to be unheard of. And here you'll see that when we have the original purchase, we may have a larger amount due. So, for example, if we had the $500 here in accounts payable, here it tells us that our supplier agreed to a $30 allowance, we agreed to a $30 allowance for some defective merchandise, and assume that the allowance is going to be taken off of our account. So what we're going to do is we're going to reduce our account balance by the $30 allowance, and also reduce the cost of inventory because that's a reduction in inventory cost. Now, if we have a purchases return where we've actually purchased goods, we receive them, we decide we don't want them, we return them to the supplier, that's going to be a little bit different. So here we have the original purchase, we have merchandise inventory and accounts payable. Here we have a return of goods. We return $50 worth of goods. So we're going to debit accounts payable and credit merchandise inventory for those items returned. We're going to make a note in the journal entry that these are returned goods, and identify what that's related to. Then when we actually pay the goods or pay the invoice and take the discount, the cash discount, our actual transaction will look like this. So the invoice we received to start with was a 2% discount if paid within a certain period of time. So now we're going to pay it within that period of time, which is 10 days. When we pay it, we have a $200 balance after the return. You notice the calculation here. You take the original purchase minus the return, and 2% of that will be a $4 discount, which you're reducing inventory with, reducing the cost of inventory, and then you will pay the cash to the supplier for $196, and they will mark the account paid in full. Here are the T accounts to show you that transaction. When we get purchases, we also get transportation costs typically. Freight is not free, and many times we may have freight included in the purchase, but many times we will not. So there's going to be some cases where we will have a cost of freight within the purchase, while will be added to the purchase later. So many times what will happen is we'll order the goods, we'll receive the goods, and at the same time receive a bill for the shipping or the freight. Now, depending on how the items are shipped, there's a very old tradition here. FOB stands for free on board, and basically that means this is the point at which the goods go onto the shipping truck or train or however they're getting to the destination, but this is the point where they go on free. This is the person that's not paying. So if it's FOB shipping point, that means that the buyer is actually going to pay for those goods, or that shipping, not pay for the goods, but also pay for the shipping. If it's FOB destination, that means the seller pays for the shipping when it loads it up and sends it out. So if we're going to do an FOB shipping point where the buyer, we receive the goods, we pay the freight company. We're going to take whatever cost that is that we've paid for in the freight and add it into the cost of merchandise inventory. So we'll have merchandise inventory debit for the cost of the freight and a credit to cash. The seller, on the other hand, if you're selling these goods, you're going to debit delivery expense and credit cash when you pay for that. So there's a lot of different ways that you can deal with this. Now, when we talk about the cost for freight, that's just going to be a direct addition to merchandise inventory because it is in any of the costs that it takes to get the merchandise to our place of business and ready to sell. That's going to be a part of the cost of the merchandise. And that transportation will go into the cost of merchandise inventory. So if we look at how we purchase items, we'll have some different items that we can actually consider that might impact the total ending cost of our inventory. So in Z-Mart's list of merchandise purchases, you'll see they have merchandise purchases of $235,800. They have received purchases discounts of $4,200. What that means is that they've exercised these discounts when they've actually made the payments, so that they've seen that much in discounts for cash discount. Purchase returns and allowances, we're going to put those all together, and we're going to say if we return it to the supplier, it's going to be included, but we may also have an allowance in here. An allowance is a case where you have some defective merchandise, but the manufacturer or the supplier will look at it and say, look, if you keep it, we'll discount the price for this amount, and if you're agreeable to that, you just keep the merchandise. We'll reduce the invoice by this amount. Many times that's an attractive way to go because they don't have to take the merchandise back, and the retailer can turn around and sell it at a reduced cost to the customer. And finally, we'll add in the cost of transportation. So by the time you deduct returns, allowances, and discounts, and then add in transportation costs or freight, you have a total of $232,400. And that's basically going to be the way that you acquire the merchandise. Now, when we sell the merchandise, we're going to deal with many of the same issues, but we're going to be on the other side of the coin because we're selling these to our customers. Many times we will sell these on credit to our customers and offer them a discount similar to the discount we received. So what we have to account for here are two things that are parallel, but they're different. So we have to account for the sales price that we're recording, the revenue that we'll get. The sales price will be the cost of the goods plus a markup percentage that will allow us to cover our operating expenses and earn a profit. So this revenue received is going to be a certain amount higher than whatever it was that we paid for the goods. So we have the goods that we purchased and the cost of goods sold. When we're talking about that, that's the cost of getting the goods to our location and actually getting them sold. And so these costs of goods sold are going to be separate from the revenue. So when we record these, we're going to do a sale, and then we're going to recognize the cost of goods sold for that sale. So here is the sale that it's recorded. Z-Mart sold $1,000 of merchandise on credit, terms net 30 on November 12th. So they're receiving, or going to receive, $1,000 in future payment from this customer. So they debit accounts receivable and credit sales. Now that's the retail side of that transaction, but that's not the only one we need to do. We need to recognize that by selling these goods, we've moved them out of merchandise inventory and into cost of goods sold. So for the cost side of this, which is what they show here, we're going to take the cost of this merchandise out of merchandise inventory as a credit, and we're going to debit that same amount to cost of goods sold to show how much we sold it, or how much the cost was related to that sale. In this way, we can look at any transaction and see exactly what our gross profit is on that transaction. If we offer a sales discount, just like the discount that we took advantage of, and we may want to do that. So here, they make the same credit sale, but this time it's 2% 10, net 45, meaning that if they pay in 10 days, they get the 2% discount. If they wait for 45 days, they pay the full price. So within the 45-day period, that's when the bill will actually be due. So the first part of this transaction is an accounts receivable to identify the sale, and a credit to the sale for the $1,000, an identification of the terms of the sale, and then we also record cost of goods sold as an increase, and merchandise inventory as a decrease. When the buyer pays within the discount period, and we say we have a 2% discount, and they have a bill of $1,000, that 2% discount is going to be $20. So what we're going to actually receive from the customer is the reduced amount of cash, $980. We're going to mark the entire $1,000 accounts receivable bill as paid by crediting an accounts receivable for that $1,000. There will be a difference then of $20 that we'll need to include in sales discounts to make up the difference between the two numbers. If they pay after the discount period, we don't have to worry about it. We just record the payment at the full price. We can also make sales and then have a return or an allowance. So if we, in this case here, a customer purchased some items and then returned them for $15. They sold for $15 and had a cost of $9. So to record the sales portion of this, we need to put this in sales returns and allowances, which is a contra account to sales, and it's a debit normal balance. So we're going to debit this for the $15 return. We're going to credit cash because we gave the customer their money back, and then we're going to go down here and make sure that we move these goods back into inventory and out of cost of goods sold. So the cost was $9. They gave us that in a problem. So we're going to add that back to inventory and take it out of cost of goods sold, which is a debit to inventory, credit cost of goods sold. If the returned goods are defective and we cannot resell them, or if there's some portion of them that are, we may do something like this. They recorded the return. They returned $9 worth of goods, or that was the cost on it. But out of those goods, $7 of that was lost. We couldn't sell it again. It was not something that we could put back on the shelf. So we're going to show that as a loss from defective merchandise. And then we'll have a debit in merchandise inventory for the difference between the 9 and the 7, which is the $2. Now, if a buyer isn't satisfied with the goods and they come back to us and they complain about them, we may offer them a discount in order to encourage them to keep the goods rather than return them. Here in this example, that's exactly what happened. And the seller said, well, I'll give you a $10 price reduction if you keep the goods. And the purchaser agreed to that. So here's what would happen. You'd record $10 in sales returns and allowances and $10 debit to sales returns and allowances and $10 credit to cash. That's the revenue side of it. So basically, you're not really, and in this case, you're not really returning the goods into inventory, so there would not be a cost side of this. You're just changing the amount of the sales amount because of some difficulty with the product. So when we adjust these accounts and close for merchandising businesses, what we're going to do is we're going to look at what exactly are we going, how do we adjust inventory? So one of the things that we mentioned in class was there may be merchandise inventory shrinkage. And shrinkage can be the loss of inventory through a number of different ways, but one of the primary ways is through theft. Shrinkage can also refer to the loss of merchandise due to spoilage or something of that nature. But here they talk about Z-Mart having a balance of $21,250, but the physical account only shows $21,000 in inventory. So we're going to do an adjusting amount of $250 to basically reduce inventory. And this is going to be attributed to shrinkage. So we're going to debit that to cost of goods sold, because we don't know what happened to it. Credit merchandise inventory to show that reduction. So any of those accounts, like sales discounts, returns and allowances, you may have adjustments in those because of different items like this, where you're adjusting for a return or inventory shrinkage or something of that nature. Okay, when we do the closing entries, this really doesn't change a whole lot with merchandiser, other than we have to deal with cost of goods sold and sales discounts and sales returns. Those accounts, and then of course merchandise inventory is a part of our accounting system too. But since it's a permanent account, we don't close it. So the closing process is much like what it is for a service business. We begin by closing out all the credit sided entries, and here we have one, sales. We have $321,000 in sales, so we want to debit sales for $321,000 and credit to the same amount to income summary, because income summary will be that place where we'll hold or identify the income from the business and the adjustment that needs to go into the equity section. Okay, then we close all of the debits that are in the temporary accounts. This will include sales discounts, sales returns, cost of goods sold, along with all the normal expense accounts that we've seen so far. So that amount will be a $308,100 debit into income summary. The difference between the 321 and the 308 is going to be our net income. Now, the difference is shown here because next step is that we close income summary to retained earnings. We do that because we want to show the adjustment that's taking place as we close out those accounts, and income summary is where we capture that, but that adjustment will increase retained earnings with the net income, and that's what we're doing here. So we have a debit to income summary to close that out, and a credit to retained earnings that will increase that. And then the last thing we do is to close the dividends account to retained earnings as well. And if you recall, dividends represent pulling cash out of the business for the owners. So we're going to show that as a reduction of retained earnings or a debit, and then we'll show the dividend credit here that will close out the dividend account. So there's a good summary here of different transactions and entries that they have. right here at Exhibit 412, you'll see a number of these highlighted, but they show the merchandising transactions for purchases in blue. The sales are in green. And I would say, look at these, because many of these transactions they show here will repeat throughout the cycle, throughout the accounting cycle. Then when we get to adjusting entries, we have an adjustment for shrinkage that we need to account for. We also adjust for period ending adjustments, any sales discounts, allowances, that sort of thing. Any expected returns that we'll need to account for. And then the closing, once we do the adjusting entries here, then we'll close these accounts like this. We'll start with the credits, debit, sales to close it. Credit income summary, because that's where the income is now. Then we'll debit income summary for expenses or debits. And then we'll go down the list of those that we need to put in with income summary. Now, these are going to include all the expenses, but you're also going to include things like sales returns and allowances, sales discounts, and cost of goods sold. So those items are in the expenses area, or those items are going to be in the adjusting or the closing for the expense items. So if you look at financial statement format, we've been working most of the time in a single step income statement. They're showing you here what really happens. Typically with a merchandiser, you're going to have a breakout in different sections. You're going to calculate the net sales and the gross profit in the first section. And then many times these merchandisers will identify operating expenses and selling expenses versus general administrative expenses and take those out. Then they'll identify an income from operations number. And then from that, they will either add or subtract other items here. In this case, they have interest income, they have a gain on the sale of a building, and some interest expense. So those items are going to be shown here. Then you arrive at final net income. So the single step income statement looks like this. This is what we're much more familiar with. Basically listing out all the revenue sources and then subtracting out all the expenses. We've talked about a classified balance sheet before, where we identify current assets and long-term assets. Current assets are going to include these items they list here: cash, accounts receivable, merchandise inventory, office supplies, store supplies, prepaid insurance, and so on. So we look at those as well. Now, as far as Chapter 4 is concerned, that's pretty much everything I wanted to cover here. You'll see in the basically in the addendum to this chapter, or the appendix to this chapter 1, you're going to see some calculation of ratios and financial statement analysis. These are good, but we'll cover more on this when we get to Chapter 13. So that really covers everything that we wanted to cover in Chapter 4. There's some problems here. We'll go over a problem in class. We may not do the entire thing, but we'll certainly go over a part of it. And then we'll see you for class, and we'll jump right in where we left off. And then we'll also get into Chapter 5, inventory, which will be our next video.